So guys, just like we spoke and discussed yesterday, we just said that I'm just trying to remind you each and everything before proceeding. Whenever you encounter a question of lease, read the question and you have to understand on whether you are required to deal with the lessee side or the lessor side. All right. Yesterday we started speaking about the lessee side, and we said that when you are dealing with the lessee side, you should worry about nothing on whether the lease is a finance lease or an operating lease. There is nothing to worry about should it come to the computations. That concern will only arise when we deal with lesser accounting. So as for now, we said that you have to record the right of use asset, so you debit it, but also you have to credit the liability, that's the lease liability, just like that. But that was the initial measurement. Now we need to learn the subsequent measurement. How do you deal with those things subsequently? Actually, this subsequent measurement is something very normal. You don't need, you can just do it actually. Like, for example, when I speak of lease liability, let's start with the lease liability, but also we'll come to the right of use asset. But should it come to the case of lease liability, it's just normal. It's just like a normal bank loan. If you have a normal bank loan, you usually have the opening balance, and then maybe if you pay maybe at the end of the period, you first accumulate interest, or sometimes we call finance cost. And at the end of the period, you pay something. That payment actually is included there, just like that. And then you have the closing balance. Then that closing balance becomes the opening balance of the next year, and you proceed that way. So that's what we usually do when we deal with the bank loans. And actually, the same thing will be dealt with here. Maybe before going to these double entries, I should try to depict what I was just thinking of. Let me do this. What I mean is, let's say you have something like this. You say that maybe you are trying to amortize something. You just say maybe you have the year column, and then let's say it's the opening balance BD, opening balance of the lease. Let's say you might be paying the lease amount, the lease rental at the end of the period or at the beginning of the period, meaning in advance or in arrears. Now let's presume that you pay at the end of the period. So if you pay at the end of the period, that means you accumulate interest, or let's say finance cost, in other words, first, and then at the end of the year you have to pay. Let's say at the end of the year, maybe you are paying something. You can just write here payment, that's the cash outflow. And after that now, you have the opening balance, you increase it by the finance cost, and you reduce it by the amount you have paid. And this will give you the closing balance, that's the balance CD, balance close account, just like this, right? So this is how you deal with the lease liability. Now let's just presume, let's just take a normal example. Let's say you are at the year one, at the beginning of year one, and maybe you have computed your lease liability and found it to be, let's say, 10,000, just like this. Let's say you have to determine the finance cost. How do you determine the finance cost? You already have that discount rate, which you called it the rate implicit in the lease, or the incremental borrowing rate. Let's say, I'm just presuming, suppose it is 10%, you take 10% times 10,000, and this will give you 1,000, just like this, right? And here you have the payment. Now, the payments would be stated, will have been stated in the terms of the lease. Let's say you have to pay 3,000 or maybe $4,000 at the end of each year, for example. Then you would say that, oh, I have to pay 4,000. And how much would you remain at the end of the period? 10,000 plus 1,000 minus 4,000, you remain with 7,000. So 7,000 would be actually the closing lease liability. And now you have to go to the second year and you do the same thing. The closing balance of the first year was 7,000, and that one would be equal to the opening balance of the next year, right? Okay, you come to finance cost. Here, I said that the finance cost, just take the rate implicit in the lease, you multiply by the opening balance here. So I would take 10% times 7,000, which would give me 700, just like that. And then you come to payment here. Let's say the lease was just saying that you have to pay 4,000 each year. I'm just presuming this. If so with the case, you would have the opening balance of how much? 7,000 minus 4,000 is 3,000 plus 700. You would have 3,700, just like this. So you just proceed this way, depending on what the question requires you to answer, right? So this is what we do. But now, before going any further, I would like to describe something more. You know, usually when you deal with, and first of all, I've given this example, which is relevant when payments are in arrears. Payment is in arrears. Is in arrears. You know, when payments are in arrears, actually, you pay at the end. So if you pay at the end, that's why this finance cost has been computed based on the balance BD before paying this 4,000. In case the payment was in advance, just presume this. In case the payment was in advance, everything would have changed here, because when at the beginning I had 10,000, but remember I paid 4,000 already, and so the actual balance would be only 6,000. So I would take 6,000 and 10% to obtain 600 instead of 1,000. So you really need to be careful on whether those payments are made in advance or in arrears. I hope you got me on that. Okay, another point to note here when dealing with the lease is here, right? You know, let's say the question requires you to describe the accounting treatment at the end of year one. At the end of year one, as you see here, we have the closing lease liability of 7,000. But what we usually do, you will usually have to separate the lease liability into its current and non-current components. As you know, in the statement of financial position, you would have the non-current component, non-current liability, but also current liability. So you need to break it down. So you ask yourself, if at the end of year one, I have a lease liability of 7,000, but at the end of year two, that is 1 year forward, that lease liability remains 3,700. It only goes to show you that at the end of year one, I have a total lease liability of 7,000, but the non-current component is this figure here that appears at the end of year two. That's because the difference between 1 and 2 here is 1. So it seems that there is the part of this liability will be extinguished in 1 year's time. So that difference between 7,000 and 3,700, which is 3,300, I mean, should be the current liability, while 3,700 should be the non-current liability, right? So what I mean is at the end of year one, you could say that, oh, the non-current liability component would be 3,700, just like this, while the current lease liability would be the remaining balance, which is 3,300. How did we get it? We just took 7,000 like that minus 3,700, just like this, right? So this is how you arrive at the result. So whenever you are asked about year one, take this figure here, deduct the following figure to obtain the current component, and that following figure should be the non-current component. You have to note that. It's something usually very, very important. Or maybe in some cases, we usually use this. If you are told to determine the current liability, you can just come this way. For example, look at this second row. 4,000 minus 700, you remain with 3,300, which is this figure here. We can also obtain the current component this way by the difference between these two. But I think we should just go with the first principle, which I've already described, right? Yes, I think you should go with that. So if you do this, you are totally done on how to deal with the lease liability subsequently. It's very, very easy. Now, as I usually tell you, I told you from yesterday, it's not usual actually, it started yesterday, some of you. Okay. So what I would like to specify to you here is you really need to know how to do the double entries. Most people ignore double entries, but they are very important. For example, take a look here. We opened with the balance BD of 10,000. Let's say it was the initial recognition, just like we did yesterday. We debited right of use asset, we credited the lease liability. Let's say this was our lease liability. Now, remember that during year one, we had finance cost here. Whenever you see something, it means that double entry has taken place. So you really need to know if double entry has taken place, what is implied. You really need to know the implication. Finance cost, finance cost here now usually goes to the income statement as an expense. So in simple terms, I could just speak this way. This finance cost is something that always goes to the statement of profit or loss under finance cost. But the payment, payment means outflow of cash. So it will usually affect the statement of cash flow, right? And what about the balance CD? Balance CD is the closing balance. So when you prepare the statement of financial position, you would have to state the balance, the closing balance of the lease liability. So this one would always appear in the statement of financial position, just like I wrote there. So this the situation is something that you need to know and understand. Now, in the form of double entries, you can see here. If you add finance cost here, what are the double entries? It only means, finance cost is an expense. If it's an expense is of a debit nature. There is another thing that is very important. You should always note that expenses and assets include expenditures, so they are of a debit nature. While income and liabilities are of a credit nature. So if you have the finance cost here, the double entry means debit finance cost in the income statement and the credit the lease liability. Let me tell you one thing. When you are doing this advanced financial reporting, if I tell you credit lease liability, you really need to know that I'm increasing the lease liability. Do not start asking yourself, oh, if I credit the liability, do I increase it or do I reduce it? That's very dangerous. But also, if you're just not aware of that, it's something very simple. If you just decide, it won't be a problem to you. So, okay. Now, if you finance cost here, you debit finance cost, and then you credit the lease liability. That's what is just written here. Do you see this? Do you see this? Oh, debit finance cost, the statement of profit or loss, and the credit lease liability. If you use this amortization table, you just have done it automatically. All right. And then when you deal with this payment side here, payment means you give out cash, right? You give out cash. So if you give out cash, it means that cash is an asset, it is of a debit nature. So if you give it out, that means you credit cash. You go against the debit nature, so you credit cash. By crediting cash, you actually help yourself to extinguish part of the liability. So the liability is of a credit nature. So to reduce the liability, I would naturally have to debit. So in accounting, instead of saying deduct, increase, you say debit, credit. You really need to know the meaning of debit and credit here, right? So that's why here they just say debit leaves liability and the credit cash. And this one would be the double entry for the payment, just like this. And after that, you would have your closing balance like that, and everything would be fine. Sarah, you are welcome. So that's what I needed to speak to you. Always that is double entry. Double entry is everything. Okay. Now, I just need us to speak a lot on this so that when we just go further or when we just extend into that question, there should be nothing new. Now, what I'm trying to say is read the question and exam and understand. Here, I'll just say that the payment is in arrears. What if the payment was in advance? Payment was in advance. What would you have done? If the payment is in advance, that means that if you have the opening balance at the balance PD here, remember you have to pay first. So if I started with 10,000, but remember payment was done first. So this payment, I have to take 10,000 minus 4,000 first to remain with 6,000, and then I have to determine the finance cost. So if the payment is in advance, I have to swap these two things. Here I should write payments, and then on payment here, I should write the finance what? Finance cost just like this. And if you sub them this way, this is 10,000. We say that we'll be paying 4,000, right? 4,000 like this, just like this, 4,000. So 10,000 minus 4,000, you remain with 6,000. And then Finance cost, we say that the support finance cost is 10%, right? We presume this to be the rate implicit in the lease. So if you just do it that way, you would say 10,000 minus 4,000, it is 6,000, then 6,000 times 10%, this one would be 600, just like this. So 10,000 minus 4,000 would be 6,000. Finance cost would actually increase the lease liability. So it should be positive like this. So it should be 6,600, just like this, 6,600, just this way. Then we say that, oh, so I close this 6,600. This should be the opening balance for year two, just like this. And then as usual, we say that the payment is 4,000. So you come here and deduct 4,000 as usual. Just like this. And then you say 6,600 minus 4,000, you remain with 2,600. And then if you multiply by 10%, you have 260, right? Yes. You would have 260, just like this. So you proceed, you do the same. This one minus this one is 2,600 plus 260 would have 2,800. 2,860, just like this. And then as usual, you come and break down. Suppose you need to know the lease liability at the end of year one. We say you need to separate into two components, current and non-current components. So the total lease liability at the end of year one is 6,600, but 1 year later, in 12 months, it remains at this figure. That means some liability, some part of the liability will have been extinguished in 1 year's time, and that should be the current component. So 2,860 should be the non-current liability. 2,860, right? While the remaining balance should be the current liability, which is the difference between the total figure, which is how much? 6,600, then minus the non-current figure, which is 2,860, just like this. So you just take the difference and arrive at the result. What would be the results here? This one it would be 3,740, right? Something like that. 3,740, just like that. So that would be the situation. So if for my case, actually, I'm totally done on how to subsequently deal with the lease liability. Right. If you just look at the example,
maybe
yes.
For this one on separating the current and non-current component,
yes.
Is it calculated only at the end of year one?
No.
You say, yeah.
No. I mean, if the question asks you to deal with the end of year one, that means you would prepare the schedule up to the following year one and the year two, because to know the current and non-current components, you would need this year two. Because at the end of year one, this would show the total, the combination of current and non-current components, right? So if you need to break them down, you would need the extra year. For example, let's pick up here. Suppose maybe you were asked to know the current and non-current components at the end of year two, right? This is year two.
So you will need data for year three, right?
Exactly. So I would have to write here year three, and then I would come here. I would say the closing balance for year two is 2,860, and I'll write here 2,860 like this. And then let's say the payment, we don't know the payment. We just presume. Let's say maybe we're supposed to pay maybe 1,500. I'm just presuming because the question will be stating everything.
Yeah, no problem.
Okay, and then I would have to determine the finance cost. Now, how do we determine the finance cost if the payment was in advance? I subtract here first. So, or maybe let me simplify matter. Let me write 60. This figure minus this figure remain with 1,300. Then times 10%, yes, it would be 130, right? 130.
Yes.
All right. So this one minus this one is 1,000 300 plus 130. So it gives a total of 1,400 and how much in 30, right? This way. So in case now you are speaking of at the end of year two, not year one, what would be the case here? You have to determine the non-current component and current component. As for the non-current component, non-current liability component, you ask yourself, if at the end of year two I have this figure, but 1 year later I still have this figure, that means this figure still remains even after 1 year. That means
Okay.
this figure below is the non-current liability, because the non-current liability lasts for more than 12 months, right? Yes. So the non-current liability would be the figure below, that is 1,430, while the current liability component would be the balance current liability component. I would take this figure at the end of year two minus the figure below to obtain that much amount. Yes. So the difference would actually remain at, it will be the same. It would be 1,000.
The same amount.
Yes, yes. But actually it was arrived at this way. 1,400. So that's how you know, you should know how to deal with leads. All right, now it's my pleasure that we are done with this. Let's go further on the right of use assets. Okay, now as for the right of use assets, this was just the double entry. They just wrote it in the way of double entries, but I think we have seen the amortization table. Of course, for the right of use asset, it has nothing. You know, if you just know normal depreciation methods, normal accounting methods for, let's say, investment property, plant and equipment, actually, there will be no issue. Yes. So if we just proceed here, let's take a look at the right of use asset now. Yesterday, we also took a look on how to determine the measurement, how to measure the right of use asset initially, but then what do you do subsequently? How do you do subsequently? Now, it's nothing much. There's nothing much there. It's just normal. They say that the right of use asset is measured using the cost model unless another measurement model is chosen. So normally you would use the normal cost model. I hope you know the cost model even from the property, plant and equipment I-16. The cost model just says that you measure the assets at its cost less accumulated depreciation and less accumulated impairment losses. That's the cost model, right? You have an asset, you depreciate it. If it is impaired, you impair it, and then you proceed. And at this level, I hope you can distinguish between depreciation and impairment. There are two very different things. Depreciation and impairment. Depreciation is simply the systematic allocation of the depreciable amount over its useful life, right? If I buy two vehicles of this that are exactly the same, one of them is in use and the other is not in use, I'm going to depreciate them all in the same way. That's what we do. But most probably, the one that is in use is probably going to be impaired faster because it is in use. Maybe it may start getting physical damage, things like that, and then it could be impaired. So you should be able to distinguish between impairment and depreciation. So the cost model simply means the asset is measured at its initial cost, less accumulated depreciation and the impairment loss, just as usual. Depreciation is calculated as follows. How do you determine depreciation now? As for this, you need to be careful. You know why? Let's say you have an asset and it has a useful life of 10 years, but the lease is only for 4 years. For how long will you depreciate it? That is an issue. So you just need to check here. All right, so we are told that if the ownership of the asset transfers to the lessee at the end of the lease, then the depreciation should be charged over the asset's remaining useful life. This makes a lot of sense. Listen, the asset has a useful life of 10 years. The lease is only for 6 years, but you are allowed that the asset will be transferred to the lessee. That means the lessee could stay that asset for its entire lifetime. And so you should just use the remaining useful life as usual. But just presume that the asset has a 10-year useful life, but the lease is only for 6 years and you cannot extend. It's very obvious that As far as the lease term is concerned, you would have to depreciate that right of use asset over that 6-year period. So it's just like that. Simply speaking, you just take the shorter life, right? That's why otherwise depreciation is charged over the shorter of the useful life and the lease term as defined previously. That one becomes easy. You just take the shorter and then you use it. So that's the situation. There is nothing much actually when it comes to the determining the right of use assets, nothing much. But you have other measurement models. Maybe before going to these other measurement models, it's like this. Let me give you an example of, I think they have given, yes, it's fine. They have done what I wanted. They have used the investment property. PPE is property, plant and equipment. There is property there, but also IS40, investment property, there is another property. So property appears under I-16, but also property appears under I-40. Guys, it's like you're revising now. You have to be careful here. Property for I-16 is different to property for I-40. And when we speak of the word property, we mean land and the buildings only. Anything rather than land and the building is not classified as property when it comes to the International Financial Reporting Standards. So let's say you're dealing with IS40, that is investment property. There are two models there. You can use cost model or fair value model. So let's say maybe the asset under the lease, the underlying asset under the lease contract maybe is an investment property. You have used the concepts of the lease to determine the initial cost. How would you treat it subsequently? Do you use the cost model or fair value model? Now you have to understand one thing. When you deal with the investment property, for example, whenever you choose the fair value model, you have to use the fair value model for all the properties under investment property. So let's say you have chosen the fair value model and you are using the fair value model, not the cost model for investment property. And then you have the property under lease and you started using the cost model initially. That means that you could use the fair value model on that right of use asset again, so as to be compliant with the issue that all properties should be using the same model. So that's just something that I'm trying to specify here. And that's what we mean by accounting treatment. You really need to know how to treat matters. All right, let's just read. They say, if the lessee measures investment property at fair value, then IFRS 16 requires that the right of use assets that meet the definition of investment property should also be measured using the fair value model. Did you get this? This is what I was trying to explain. That investment property, property land and the building are usually in the same class. Unlike PPE, you can have property in their class and maybe land and the building, maybe building or maybe equipment, plant and equipment in the other class. Usually, even under 16, whenever anything in a given class you change the model, you have to change for all items in that class, so as to avoid selective revaluation. To avoid, let's say, the assets which have appreciated, let me revalue them. Those which have not appreciated, let them be. No, we avoid that. But when speaking of investment property, it's only property. So on investment property, everything in there, all land and the buildings are of the same class. That's why we do not need to specify the word class. Whenever you are using the investment property and you're using the fair value model rather than the cost model, even if you have entered into a lease, you have other properties under lease, you have to follow the fair value model. I hope you do remember about that concept. It's just the concept of the previous, but when you are using the fair value model of investment property, all fair value gains and losses are taken to the statement of profit or loss. You should be able to distinguish the fair value model in IS40 and the revaluation model in IS16. They are two different things, right? Okay. So you said that you should be using the fair value model even for leased assets. For example, here they say the right of use assets that are subleased and operating lease in order to earn rental income. Yes, maybe you have something like that. You have the right of use asset. Someone has leased out the building to you. You have that building, and then you sublease some parts to someone else. and operating lease in order to earn rental income. You can just do that. All right. All right, and then they say here, if the right of use belongs to the class of property, plant, and equipment, they have been very specific. You should know that you can have something under 16 or under 40. So under 40, and they are told it belongs to the class. Here they mention the word class because property is in its own class, and plant and equipment may also be in their own class. So in case the right of use asset belongs to the class of property, plant, and equipment that is measured using the revaluation model, an entity may apply I-16 property, plant, and equipment to all right of use assets. An entity may apply, right? But here is for the investment property, it is a requirement. So learn how to distinguish between I-40 and I-16. All right, the session is just going to end soon. So if you just